continuing in that vein, the hot topic these days is stablecoins. So I put together some ideas about stablecoins, just to provoke discussion, really. There is a working paper, but very rough. Let's see if I click this in the right direction. So, what are stablecoins? What do they do? It's a form of cryptocurrency that's pegged to mostly to the US dollar. In principle, it could be pegged to the euro or the British pound, but nobody wants those. So it's 99% dollars, about 0.5% euros and gold. Why do people want this virtual dollar rather than a bank account? And the answer is it's faster and cheaper. If you want to send dollar-denominated payments, especially internationally, where if you try to make an international bank transfer, it can take 5 to 10 days to clear. Domestically, that's not a problem. So I don't anticipate much use of dollar stablecoins in the US. Bank transfers are fast and cheap. But internationally, it's a lot faster and cheaper. And where it's really made a splash is in crypto markets. So people used to buy and sell other cryptocurrencies, Tether, Litecoin, Trump coin, whatever, using Bitcoin as the medium of exchange and the unit of account. Other cryptos were priced in Bitcoin. That's no longer true. Since Tether came on the scene, it's taken over. And now other cryptos are priced in Tether and paid for in Tether. And you can see the attraction. If you're selling one coin, what you get paid in, you hang on to for as long as it takes you to buy something else. You'd rather not have something that can change 7 or 8% in a day the way Bitcoin can. So stablecoins have taken over that market. I'll show a slide next. So that's the basic selling point. Lately, the stablecoin issuers have been trying to sell them to businesses for business-to-business payments, right? So buying and selling goods and services, not just virtual assets. So USDC, which is the number 2 stablecoin, although it starts with US, they all start with USD. It's always USD, some other letter. These are privately issued, not issued by government. We can come back and talk about CBDC, central bank digital currency. But USDC has been running ads saying, trying to sell businesses on using their coin for a more global, scalable, and efficient alternative to traditional banking rails. And they've got a strong case. Wiring money is expensive and it's not that fast. So this was, as of 2024, or between 2014 and 2024, you see what happens to on-chain transaction value. So on-chain meaning using cryptocurrencies, using blockchain-based payments. And Bitcoin used to have 100% of that. Started to decline as Ethereum started to be the home for decentralized finance, DeFi applications. Some other coins got a little bit of business, but stables are the big growth from 2018 to the present. They've taken over that market for online, on-chain payments. And so the big advantage of being paid in stablecoin is fast and cheap, but also it doesn't go through the banking system. Well, that's why it's faster and cheaper. It doesn't go through the banking system. So it saves all the inconvenience of going back and forth to a bank. I'll say more about that in a second. So here are the names of some of the leading stablecoins. Tether is the most famous and has the largest market cap by far. So $180 billion is the value of Tether being held at this moment, or last week. And look at the 24-hour volume. practically once a day, each tether turns over. So it's a medium of exchange. People are acquiring it in order to turn around and spend it on something else. The other coins, not so much. USDC has a little bit of payment business, but it's a fifth of their market cap. I'm not sure why people are holding it if they're not intending to spend it. It doesn't pay interest. Except if you hold your USDC in a Coinbase account, they pay you, they don't call it interest, they pay you a reward. This reward just happens to go up and down with the treasury bill rate, so we can call it interest. I have a USDC in a Coinbase account because I've been doing consulting with a crypto startup, which is legally a Swiss foundation. And so in order to pay me, it would be very expensive for them to wire money into my US bank account. Instead, they just put USDC in my Coinbase account. It's instant, doesn't cost them anything. And for me, it's just as good as having money in my bank account, because I can move it to my bank account at no cost anytime I want to. But I can also leave it there and earn interest, rewards. Or I can use it to buy Bitcoin or gold, crypto gold, or anything else. The next three I'll say more about are interesting. 8 through 14, we see PayPal, which is a new entrant. They just entered last year, introducing a stable coin. And they're trying to link it to their other payment services. So it's an interesting experiment to see if they're going to just cannibalize their own business or whether they'll be able to draw in more business. Still pretty small. The reason I went down to 14 is that at 12 and 13, we have non-dollar stable coins. We have gold stable coins, Tether Gold and Pax Gold. And their market cap is about $1.5 billion. It's gone up with the price of gold because it's the dollar value. And what they offer is you buy an ounce or however many dollars worth of gold you want. They promise to keep it in a vault in Switzerland. And so it's a cheap way to own gold or own a claim to gold, the value of which goes up and down with the price of gold. So it's a cheap way to get exposure to the price of gold. But, $1.5 billion is still small relative to Tether. Everything else is. First Digital is interesting in that its payment volume exceeds its market cap by about 7-fold. It's a little puzzling. But that's a Swiss stablecoin. So there's a lot of different legal domiciles for these coins, and so different legal rules apply. I'll talk about the attempt by the U.S. Congress to regulate stablecoins that just passed a couple of months ago in a minute. BlackRock now has a U.S. dollar stablecoin. For some reason, it's not listed like the others. It would be number 5. It's got $2.8 billion in it. And I'm not quite sure what the value proposition is, whether they want it for business-to-business payments or for crypto payments. But they're going to be a big player. Last little chart here shows you how PayPal's stablecoin is being used by PayPal. They're encouraging its use by charging no fee for country-to-country remittances if you pay with their stablecoin. I'm not quite sure why it's cheaper for them than having people pay with their PayPal balance, because then that's just an account transfer on the books at PayPal, but I think it's a kind of loss leader. But that sort of thing is what they're doing to try to ramp up retail use by people who aren't trading in crypto. Here's the total stablecoin supply, which you see is practically zero in 2020. So it took a few years for Tether to get a foothold. But Tether is the big mass on the bottom of the pile. USDC is the next one up. And then the others have very small slices. One thing to notice here is a sudden drop in the volume of stablecoins in late 2022. That was a stablecoin called Terra, maybe you've heard of it, which was based on a different model than the other stablecoins, and that model failed. But we haven't seen anybody try to replicate it since then. The market seems to have learned that that was not the way to build it. So here's how they peg. It's like pegging an exchange rate for fiat currency. And then the question is, what is the stock of assets that's used to buy back unwanted coins, or that the issuer acquires when they issue new coins? Tether and USDC are holding US dollar assets, and mostly safe and mostly liquid. Now, Tether has been rather opaque over the years. They've been forced by the New York regulators to provide a little bit more clarity. And I think the market is forcing them to provide a little more clarity, because they're actually now providing more information than was required by the New York regulators. Basically, if the price of Tether goes slightly above $1, and when I say slightly, I mean the variations, which I'll show you in a minute, are 1/100 of a cent, 1/10 of a cent at most. It doesn't vary all that much. But even if it goes up by 1/10 of a cent, it pays somebody to sell and get $1, sell at $1 and 1/10 of a cent, because they paid $1 to buy it. And if it goes below, it pays people to buy it and wait for it to appreciate. So speculators do most of the work in keeping these pegged at $1. But in the background, the issuers are prepared to buy or sell as necessary. And holders of large values of Tether or USDC have the right to redeem them. But Tether, for example, imposes a large minimum, $100,000 on redemptions. So that's not so much what you and I would use. We just count on the market speculators keeping it, arbitrageurs really, keeping it at $1. So that's the sort of standard way of backing it, with US Treasuries and other liquid dollar-denominated assets, repos. USDC has a lot of repos. Tether, for some reason, has some other exotic assets. It's only about 10% of their portfolio, but I'll show it later. They've got some gold and they've got some Bitcoin. I'm not sure why. There are other smaller stable coins that are totally on-chain. Right? So they don't have a portfolio of real-world assets. They have Bitcoin and they have Ether, mostly, as collateral. But they know the prices of those are volatile, so they over-collateralize. You need $1.50 worth of Ether to get and post it with them to be issued one more USDE or USDS or DAI. And they've got an arbitrage mechanism where it pays to sell back the coins if the price is high, and that brings the price down, and borrow more if the price is low, that brings the price up. So Terra tried to keep their price at $1 by buying the excess with a second a second crypto coin, which was totally unbacked. But this was the promise: if the price of Terra starts to fall, Luna, which was a sister coin, will be issued in enough volume to buy up the excess, and that'll bring Terra back to $1. The problem is that's not going to work if Luna also loses its value. And the two of them sort of went into a death spiral together, and it became impossible to buy back the unwanted Terra because nobody wanted the Luna either. So as I said, we haven't seen that model again. That was an idea that worked for small perturbations, but when people lost faith in it, it was toast. By contrast, when people lost faith in USDC a few years ago because it was insolvent because they had very thin capital and more money on deposit at Silicon Valley Bank than their net worth. So Silicon Valley Bank fails, that wipes out about $8 billion. That was more than their net worth. USDC depegged, went to about 75 cents. Fortunately for USDC, and for me, since I had a few $1,000s in USDC, the Federal Deposit Insurance Corporation came to the rescue on Sunday. The crash was on Friday. On Sunday, they said, we're going to pay back all the depositors in Silicon Valley Bank, even the uninsured depositors. And so my view was that was terrible policy, but worth a few bucks to me. Let's see, $3,000 times 0.25 is what I would have lost. Anyway, since then, USDC has rebounded and hasn't had any problems, and they've stopped making that mistake of having more than their net worth in any one bank. All right, so that's the sort of background of where stablecoins are. What's the policy debate about? Well, the bank regulators say, gee, these look like banks to us. And because they look like banks, we want to regulate them like banks. And they are like banks in that they're issuing spendable liabilities the way banks do when they issue deposits, and the way they used to do in the 19th century when they issued banknotes. And they take the funds and they buy earning assets with them, which serves to back the liabilities they have, makes it possible for them to redeem or buy back their liabilities. But they're not guaranteed. They don't have any insurance. And this is puzzling to me. They keep very low loss reserves, basically zero, very thin capital, less than 1% in the case of USDC, about 4% in the case of Tether. So they are a little fragile, and USDC proved it was fragile by going insolvent until the FDIC bailed it out. Do they need to be regulated like banks? Well, they're not run prone if they're properly structured, if they're properly collateralized and have enough net worth. So there isn't any reason for them to be run prone. And this is all transparent. I mean, at least they can make it transparent by saying, here are our assets, and you can see they're unimpaired. And since there's nothing that makes them all invest in the same portfolio of assets, well, until the regulators came along, there's no reason for contagion. There's no reason to infer from the problems at one stablecoin that the next one is in trouble. And so they don't really need deposit insurance to prevent runs. That's the standard rationale for regulating banks. And without deposit insurance, we avoid the moral hazard problems of deposit insurance. Right? So these stablecoins, as long as we practice a kind of caveat emptor policy, have to stay on their toes, have to convince the public that they're solvent, and have to actually be solvent. All right. On the 1st of October, the head of the Bank of England got into the stablecoin policy debate. And here's what he said in the Financial Times. In the coming months, we will publish a consultation paper on the UK's systemic stablecoin regime. And I find this a little amusing because this is an imaginary object at this point. We're going to require them to meet some kind of standards. In particular, UK stablecoins should have access to accounts at the BOE. And it's not clear when he says should, he means we're going to require it, or whether simply we're going to recommend it. I think he means require, in order to maintain a stable financial system. So that now, having an account at the Bank of England has an advantage in that it provides a cheap way of clearing payments. But the system for clearing stablecoin payments is already cheap and fast. The additional thing that it provides is surveillance or supervision, if you want to be polite about it. It means the Bank of England would have a window into what's going on that they don't currently have. Here's the current volume of British pound stablecoins. It's about, well, it's less than £500,000, $600,000. Sorry, that shouldn't be 3 trillion, that should be 300 billion. In a $300 billion market, that's pretty small. If you're interested, the NX British pound. But they don't do a big volume of payments, and they don't have a large market cap. And the second one is so obscure that the crypto listing services don't even have a market cap for it. All right, in the academic debate, the chief criticism of stablecoins has been that they're unsafe. And in the US context, the phrase they like to use is they're like wildcat banks. And wildcat banks refers to a particular episode in US banking history in the 1830s, 40s, 50s. There were banks that allegedly were fly-by-night operations, that's what it means. They set up an office so far out in the countryside that it was surrounded by wildcats. Right? And if you went to try to redeem their banknotes, well, either you couldn't find them, or you'd be eaten by the wildcats, or they'd be gone by the time you showed up. There were a few such banks, and really maybe a dozen, maybe 2 dozen, depending on how you count. A serious study of banks, how many banks there were that closed within a year and left note holders with less than $1, less than 100 cents on the dollar, has found that there were very few. Like 1 or 2% of the banks in some states and closer to 0 in other states. But those stories of those banks are very colorful, and they've been spread by historians. And so this is widely believed, even by people who should know better. So here's Lael Brainerd, who was then governor of the Federal Reserve System. A predominance of private monies may introduce financial stability risks because of volatility and the risk of run-like behavior. And we know this because in the 19th century, when there was active competition among issuers of private paper banknotes, it was notorious for inefficiency, fraud, and instability. So it's notorious among some historians of 50 years ago, but there's been a lot of scholarship since then showing that inefficiency, fraud, and instability were actually not the general case. They were problems in some states, and if you ask why, what distinguished those states, each state had its own bank regulatory system. There wasn't any federal bank regulation at that time. If you ask what distinguished the states with weak banking systems from the states with better banking systems, the answer was poorly framed financial restrictions on the banks in those states. In particular, there was a limitation on branch banking. Banks were not allowed to branch across state lines, and in some states, they weren't allowed to branch even within the state. So one bank, one office. That's a recipe for poorly diversified banks and poorly capitalized banks. And some states used this so-called free banking legislation, and the label confuses people because it wasn't free banking in the general sense. It provided freer entry, but the terms were you had to collateralize your banknotes with the assets that the state government approves. And some state governments use it as a way of selling their own debt. So you had to buy our state's bonds. The states that ran into the biggest problem said, we'll let you back your notes with the bonds from any other state, and we'll value that collateral at its face value. So that was a recipe for the banks to go out and buy the cheapest bonds they could buy. So if you could buy bonds for 60 cents on the dollar, you would get the right to issue $1 worth of banknotes. And so this was sort of set up to encourage fly-by-night operations. And the banks that failed in droves in Wisconsin and Minnesota were heavily invested in bonds of southern states, because this was, now we're talking about the late 1850s. On the eve of the US Civil War, those bonds were selling at a big discount. And the banks in Minnesota and Wisconsin, those were the worst states for bank failures, had like 70% of their assets in southern states bonds. And when the war came even closer and the value of those bonds fell more, it wiped out the banks, or about half the banks in each state. So that was a problem of bad regulation, not a problem caused by the fact that they were private issuers or that there was active competition. We know that because we look at other states, we didn't have these problems. And if we pull back even more and look at the rest of the world, we know that this is not an endemic problem to banking. So it's very misleading to focus on a few states in this period in the United States history. Other than that, banknotes were not volatile or run-prone. So if you look at Canada, not that far away from the US, or look at Scotland, this case I've studied, or dozens of other cases, you don't see inefficiency, fraud, and instability. All right, but the US state systems that were fragile because of poorly designed regulations. George Selgin has a good piece on this. The academic version of the argument comes from Gorton and Zhang. So Gary Gorton is an interesting academic. I don't know if you're familiar with him. He did some very important work in the 1990s on the market for banknotes in the US, gathered a big database showing discounts on banknotes, which he found, not surprisingly, when you see banknotes trading at a discount, it was because they had gotten away from the city where they were issued, and the bank of issue wasn't allowed to set up a redemption office to buy them at par somewhere else. And there wasn't enough volume for them to make an arrangement with a bank in another city. Except in some places, we do see those kind of arrangements where banks arrange with one another to buy their liabilities at par, and then you had a big par circulation network. So northeast of the US, what we call New England, there was a clearing system organized around the Suffolk Bank, and they had par circulation. Around Philadelphia, there was par circulation. Other parts of the country, not so much. Gorton and Zhang say, well, what we know from economic theory and financial history, back to Gary Gorton, sorry. Gorton became more interested in sort of finance, and he was the person who designed the investment strategy for AIG, which was the insurance company that went belly up in the financial crisis. And he wrote about his experience watching his model get crushed under the title, Slapped by the Invisible Hand. I took that to be a personal reference to how he felt about the market telling him that the strategy wasn't robust. But since then, he's been making the case for centralizing and putting under government all payment systems. So he's a big advocate of central bank digital currency, and he's an implacable opponent of stablecoins. And here's his argument. The theory is that circulating private money is not an effective medium of exchange. Right? There's no qualification here, it just is not. Because it is not always accepted at par, and its issuers are vulnerable to runs. Well, this seems like, at the very least, an overstatement, because we've got lots of examples of private banknotes circulating widely at par. Where? In Scotland, in Canada, and anywhere banks were allowed to set up branch banks and thereby redeem their own liabilities away from the home office. But this theory that it always has to be accepted at par. Gorton and Zhang call the no questions asked principle. And their statement is, if anybody has any doubt about the value of a bank liability, then it's ineffective as money, meaning it won't be widely accepted. But he just made that up. I mean, there's no principle of monetary theory that says it has to be universally accepted to be widely accepted. It's not all or nothing. He specifies it has to be accepted in a transaction without due diligence on its value. Well, if that's the criterion, then applying it to stablecoins seems inappropriate because people do use Tether without asking any questions. Even though it's true the value of Tether does fluctuate within a very tiny band around $1, plus or minus 1/100 of a cent, that's not much of a question. Nobody stops, says, no, I'm going to wait till it's up to $1 before I accept it, as opposed to being worth 99.99 cents. So there really isn't any value diligence called for when the deviations are so negligible. And in the 19th century, we see banknotes circulating at par within the area in which they could be redeemed. So Scottish banknotes circulated at par within Scotland. They even circulated south of the border because they were more trustworthy than some banknotes in northern England. But they did not circulate in London. And of course today, if you take a Scottish banknote into Sainsbury's in London, they won't accept it. They're not required to. It's not legal tender. And this is the general experience, that if there's branch banking allowed, non-par circulation is not a problem. In the US, it was a problem because we didn't allow branch banking, not because of it being private. So here's the intraday price variation, and the important thing, it looks pretty spiky, but you need to see the scale. So these are fluctuations between $1 and 2/100ths of 1 cent and $1 and 6/100ths of 1 cent. And there's a lot of negative correlation, right? So the market keeps correcting back. It doesn't stay at any elevated or depressed level. And for some reason on this day, which was 18th of October, it was fluctuating around a tiny bit above $1. So Gorton and Zhang, although they're more sophisticated, like Brainerd, they're giving a distorted picture by focusing on this atypical case of the so-called free banking era in the US, which wasn't free. It was decentralized, but it wasn't free. And they studiously ignore any other experience. There are no references to Scotland in their paper. There's a single footnote about the Canadian case in which they dismiss it based on another paper, which is a dubious paper. They don't mention any other countries with free banking experience. Right? But if you step back, the historical experience with privately issued currencies has been pretty good. It was the most popular medium of exchange in the 19th century, private banknotes. Everybody got paid in private banknotes. They got to pay envelopes stuffed with banknotes. And the private payment system kept up with technological innovations. People were using, as soon as the electric telegraph was introduced, the killer application was wiring money. That's why we still call it wiring money. Sending message to a bank in another place saying, I'm going to come by and pick up some money. Bank offices had half the telegraph keys in the United States. It was mostly a financial application. In Canada and Scotland and everywhere that allowed branching, there's no problem with non-par circulation. And if you think about it from the point of view of an issuing bank, it's bad for business to have your liabilities fall to a discount if people carry them away from the head office. And so banks deliberately made arrangements to make sure they were accepted at par in other places. They made explicit agreements with one another. I'll accept your notes at par if you'll accept my notes at par, and then we'll get together at the clearinghouse and swap our liabilities on each other. So we're not overly exposed to one another. Anyway, there's a lot of literature on this, which Gorton and Zhang studiously ignore. Kevin Dowd edited a book called The Experience of Free Banking, which is now out in a second edition from the IEA, 2023. So that looks at case studies, free banking in Scotland, free banking in Australia, free banking in Switzerland, Sweden, Colombia, and so on. So we've got some similarities to banknotes. They're issued competitively. Most of the competition is on non-price dimensions, ease of use, because they don't explicitly pay interest, although if you deposit your stable coins in an account at Coinbase, you get interest on them. But stable coins are still a niche payment medium. They're not, nobody's paid in stable coins, well, with rare exceptions. They're still mostly used by traders in crypto markets. And Tether designed its policy with these professional traders in mind. For Tether, for USDC, and for the others, stablecoins are their only liability, whereas banks of issue also were deposit banks, so they had other liabilities. They were a little better diversified on the liability side. Now, if you are considering holding a stablecoin, it pays to do some diligence because they are not guaranteed. So you want to be sure that the issuer has a solid model. You don't want to put your money in something only to find out it's designed like Terra and Luna. Historically, banks competed on safety. So these are typical ads in the US, banks advertising for depositors, and what they list is their capital. This one had 1.5 million in capital. This one, assets 13 million, capital 1 million. So that's, and surplus. Surplus was retained earnings. So that's a 15% capital ratio. And that was typical for banks before deposit insurance. When deposit insurance came along, and banks used to actually paint in their window, we have $5 million in capital. When deposit insurance came along, they hired somebody to scrape that off and just put in a sticker that says protected by FDIC. It's a substitute for having capital. So it seems to me that competition has got to, if they're going to sell this to businesses, to small businesses, to consumers, to households, there's going to have to be more transparency to persuade people that it's safe to hold. So here's a breakdown, the most recent one I could get in this detail, so this is 2.5 years old, of Tether's assets. They have the frustrating habit, both Tether and USDC, of calling all their assets reserves. Right? Traditionally in banking jargon, your reserves are only your cash assets, not anything that was subject to any risk whatsoever. So they call them all reserves. And one of the 82% of their reserves, that is their assets, they call cash and cash equivalents. And then those are broken down here, 71% treasury bills. So 71% times 82%, you get something like 60% treasuries. Non-US treasury bills, issued by who? Denominated in what? I'm not sure. Repos, bank deposits, money market funds. I'm willing to accept all those. They no longer had any commercial paper. But here are some of the strange things they have. Corporate bonds, precious metals, digital tokens. So they have some Bitcoin on their balance sheet. And not quite sure why. At this point, they were leveraged 86 to 1. Their capital ratio was about 0.11%. It's since gone up. It's now in the neighborhood of about 4%. All right, so caveat emptor. Now, is caveat emptor a viable policy? Well, if these were everybody's everyday payment system, there would probably be more political demand for safety. But since the users are pretty sophisticated, self-selected, it's not clear why we can't just let them take their lumps if they put their money in the wrong place, the way we do with people who invest in stocks or mutual funds, right? So you go into Bank of America in the US, they've got their banking side, and then they've also got a brokerage house under their roof. And over the desks over the brokerage side say, you may lose money with our investments. These accounts are not government guaranteed. These are mutual funds or stock investments. But we let customers choose to expose themselves to that risk. So why not the same with stablecoins? Is there a risk of stablecoin failures spilling over into banking? As long as banks are not issuing stablecoins on the same balance sheet with everything else, I don't see why there would be a spillover. Stablecoins make a dollar-denominated, safe, fast, cheap transfers available, and so it seems to me pretty much undercut the case for central bank digital currency. A lot of that case is premised on there not being any such payment mechanism. Actually, Venmo is also fast, cheap, and safe. But part of the resistance to stablecoins comes from people who are, for whatever reason, committed to a central bank digital currency, like Gary Gordon, like Christine Lagarde. So, what's the case for bringing them under central bank supervision? That's what Andrew Bailey was proposing. Well, they're already immediate, cheap, and the way they differ from having stablecoin issuers clear using an account at the central bank is that they're not surveillable in real time. And therefore, they're not censorable in real time. So if you move it all to the central bank, you're going to have know your customer requirements that are much more stringent. So the current status of stablecoins, at least for a US citizen like me, is you can have money transferred to you, to your wallet. There's no know your customer vetting. If you have it in an account at Coinbase, there's no vetting. If you try to take money out of your account at Coinbase and put it into your bank account, now there's vetting. Now you've got to provide all the know your customer information because now you're being hooked up to the banking system. But maybe that's a faster, cheaper way of processing payments. In that case, let the stablecoin issuers who want to get central bank clearing accounts. If they don't want to, if they want to be less surveillance and censorship prone, let them pursue that strategy, is my attitude. The US Genius Act was passed in July 2025. So this is the attempt to legalize stablecoins because their legal status was unclear in the US. And in particular, the Securities and Exchange Commission hadn't made up its mind whether these were securities, and therefore under their jurisdiction. So Congress said, well, we're going to take them off of your jurisdiction, but we're going to have them regulated as federally chartered institutions, or federally supervised institutions. So you have to be a bank or under federal supervision. So you have to apply for recognition as a stablecoin issuer. If you're not a financial firm, you need special dispensation. But so far, all the issuers, even the new ones like BlackRock and PayPal, those are financial institutions. If you're domiciled offshore, you've got to meet the compliance requirements, which haven't been spelled out yet. Like many acts of the US Congress, there's a wish list, which lawyers have 2 years to fill in before the rules become effective. US trading platforms not allowed to list non-compliant stablecoins. So Tether has to decide what to do, because they're currently domiciled in El Salvador. They used to be in the British Virgin Islands. Now they're in El Salvador because the government of El Salvador welcomed them. If they want to trade on US exchanges, now currently US citizens are allowed to trade on non-US exchanges, but they could close that window. Tether has to decide whether to just forego those exchanges or issue a US compliant version of Tether. And in a sense, there are multiple versions of Tether because you can buy it on different exchanges. You can buy it on Solana, you can buy it on Ethereum, you can buy it on any other platforms. Stablecoins have to be redeemable at par. I'm not quite sure whether 0.9999 is close enough to count, or whether it's got to be $1 or above. It's got to be backed with approved assets. They haven't fully specified the list, but treasury liabilities are especially favored. The issuers have to certify that they're meeting the requirements. They haven't said what the capital and liquidity requirements are yet. And they may not pay interest. I heard a talk by somebody who was the legislative counsel to the senator who was the chief author of the act, and he said the large bank lobbies, the American Bankers Association, lobbied us heavily to make it illegal for stablecoin issuers to pay interest because they don't want them taking away their deposit business. But he says we fooled them. We deliberately left a loophole in where if you have an account at an exchange, like I mentioned before, Coinbase, they can pay interest on your account balances. So it's not USDC paying you interest, it's Coinbase paying you interest. They've taken your USDC and presumably invested it in something that's paying interest. Well, they've got a balance sheet. We know what they're investing in, mostly treasuries. And the rewards that Coinbase pays go up and down with the treasury rate. So what was the motivation? What seems to have been the winning argument in the Congress was this is going to make stablecoins more acceptable around the world, US dollar stablecoins, more popular around the world. And since we're requiring that they back them with US treasuries, this is going to be a big boost to the demand for US treasuries. And that's good because we're going to issue a lot of debt in the coming years. We all know that. So we need somebody to buy it. The stablecoin issuers are going to buy it. So the US Treasury Secretary Besant went on X and said it's win-win-win for everybody involved, the issuers. So he's saying it's good for the issuers to be restricted because now they get our stamp of approval. It's good for the US Treasury. It's good for stablecoin users. I guess because they can't do their own diligence. And now they're being, sort of the backing is being certified. Now, Tether is the big dog. Tether, as I said, is domiciled offshore. And they've been notorious for ignoring US restrictions. So money payment services are regulated by state authorities. If you have a business that's involved in transmitting money, you need a state license. And if you want to be in all 50 states, you need 50 state licenses. And USDC went through that process, got all those licenses, and their sales pitch is, we're compliant, you can trust us. Tether said, nah, we're just easy to use. And look, the price is rock solid at $1, you can trust us. So the parent company of USDC, Circle, has for years been lobbying to bring stablecoins under the regulatory umbrella because they thought that would give them a leg up and push Tether out of the market. So there's some bit of anti-competitive rent-seeking here. I don't think the effects of the Genius Act are going to be all that great. It doesn't make any new product features available. So I don't see where it's going to grow the market for stablecoins in any discrete way. All it provides is some kind of US government permission is now being granted. But people holding Tether haven't worried about that for years. I don't know why they would start worrying about it now. If they were that concerned about compliance, they would have moved to using USDC rather than Tether. And so if there isn't any discrete upshift in the trend of the growth of stablecoin volumes, I don't see where the big shift in the demand for US Treasuries is going to come from. Meanwhile, parts of the Act inhibit US stablecoin issuers, namely the ones who were collateralizing with crypto assets. So are they going to switch to? That would undermine their whole business model. Or are they just going to go offshore? That doesn't do anything to increase demand for treasuries. And this idea that they can't pay interest, which is the strategy of USDE, one of the ones that's crypto-backed, pushing them out of the market. But sort of setting the terms of business is kind of restricting the amount of creative innovation stablecoin issuers can do. I mean, it's a pretty young market, and to say, okay, now we have the correct model. The correct model is don't pay interest, back it with US Treasury assets. It's not clear that's the only viable model. And there's a problem of having them all the same, which is you've created a monoculture. And we know monocultures are susceptible to diseases that run like wildfire throughout the entire system. So if you have different stablecoins backed different ways, if people lose faith in one model, they can move their funds to a different stablecoin. The system as a whole doesn't have to collapse. But if they're all the same, and so they're all invested in treasuries, and there's a shock to the US Treasury market, you have a systemic crisis. If people are running on one stablecoin because the value of treasuries have dropped, they're going to be running on all the stablecoins, rather than pulling money out of the ones that are treasury backed and putting it into the ones that are backed by other assets. So that's a danger, it seems to me. Lastly, let me say a little about the ECB, which has been not friendly toward stablecoins. And their official position is we're worried about them being unstable, about them being run-prone. Meanwhile, Tether's not been run-prone. But I think the unofficial reason is they see it as a competitor with their central bank digital currency project. And that's what they're eager to issue. And they're worried that Euro stablecoins would make a Euro CBDC redundant, because now it's an on-chain, fast, cheap method of payment. What's the point of having the European Central Bank do that? A crypto analyst, named venture capitalist named Nick Carter, is a good source of information about stablecoins. What he calls a two-tier CBDC is one where banks handle the retail end, and the central bank just handles the payment rails, the clearing system. He says, look, a stablecoin is just as safe as that, to the extent that it's backed by safe assets, but it's far more insulated from government interference, so why would anybody want a CBDC? But if you want financial surveillance, then it makes sense that you want a CBDC. It makes sense that the Chinese government wants everybody to use the Chinese government central bank digital currency, and not WeChat Pay, and not Alipay. So for them, it's a feature, not a bug.